Right now we have Barry Burns from Top Dog Trading coming on. He's going to be discussing options and solving your trading psychology challenges. So go ahead and take it away, Barry.
All right. Thank you, Reed. And thank you to everybody. Hey, it's great to be here, enjoying it, loving the camaraderie of my colleagues here today, and really appreciate Investor Inspiration for putting this all together and bringing so many people together. Wow, we got a lot of people here. I just looked down to see. That's exciting. All right, well, fantastic. So today, yes, I am going to be helping you with an issue that a lot of people struggle with, and that is absolutely critical for your trading, and that is how to solve your trading problems when it comes to the psychology issues that so many people have challenges with. So we're going to provide you with some simple tips to dramatically improve your trading discipline, remove fear, hesitancy, trade with confidence and consistency. So let's jump right into it. And by the way, a couple things before I do jump into it, wanted to let you know. I'm going to be giving you not just a bunch of positive thinking or platitudes or ideas or general concepts, but I'm going to do some of those things, but we're also going to get into two very specific exercises. So today I'm going to give you two very specific exercises that you can take and use absolutely free. And these are things that I have used myself and I've used with my students. Some of them have paid thousands of dollars for these exercises. You're going to get them for free today. And they work. They've been tested in the real world with real traders. And I'll tell you, they've created dramatic differences in people's results. And also, unfortunately, I don't have anything to sell today, so I apologize in advance for that. So just good free education here today. In fact, I'll tell you what I will do, though. I'll give you one of my courses for free. So that's your reward for sticking until the end here. And yeah, you go with one of my courses for free. It's a good one. It actually gives you also one of my trade setups that I take. And this trade setup is called the rubber band trade. And you're going to get it in the course for free. So it's a trade to be able to actually take, use, and give you all the rules, the filters, etc. All right, so having said that, let's jump right into it. A little bit about me. I've written the book Trend Trading for Dummies, part of the famous Dummy series of books. I'm sure you've heard of that series. I've won Reader's Choice Awards from Stocks and Commodities magazine pretty much every year since I've been nominated, which has been quite a few years. I've also been a contributing author. One of the books was The Complete Guide to Investing in Derivatives, and I work with various companies, exchanges, software programs, and so forth. They bring me in to help train their traders. So that's just a little bit about my background. If you want to read my entire background, go to topdogtrading.com. And that is the company that I started, and I still operate. Important disclaimer, first of all, trading is not suitable for all people. Some markets are leveraged, so it's possible to lose more than the amount of money deposited for a position, and the Forex markets are certainly very leveraged. Please only use funds you can afford to lose and that fits within your overall financial plan. All information in this presentation is for educational purposes only. It should not be taken as investment advice or recommendation or endorsement to buy or sell any specific investment. Use this information at your own risk, and it's for general purposes only. And we assume no responsibility or liability for errors or omissions. Okay, look over at my lawyer. She's smiling. Good. She never smiles. Lawyers never smile. You ever notice that? Okay. So there's two aspects to the psychology of trading. The first aspect is the psychology of the markets themselves. Normally when we think about the psychology of trading, we think about our own individual psychology as a trader. And we're definitely going to get into that, and that's where the exercises are going to come in. However, in order to be successful at trading, I feel that it's very important to understand the psychology of not only yourself, but of the markets that you're trading. So, what moves the markets? Let's talk about that for a second. Do fundamentals matter? You know, my dad was a trader. He was a stock trader, and so I started trading stocks and later got into futures and forex and commodities and options, and now I trade it all. But my dad, he did a little bit with technical analysis. Now I'm primarily But he did a lot with fundamental analysis, and so I'm quite familiar with it, and I decided to move on and use primarily, at least, technical analysis. So I look back on it and I ask, well, does fundamental analysis really matter? And the answer is yes, it does. Fundamentals do matter. But there's some problems with it. So, for example, when companies come out, or well, primarily companies come out with numbers, sometimes we find out those numbers were wrong, or there was misreporting, or literally even book cooking, or they revised those numbers later on. And so the numbers can't always be trusted. That's number one. Number two is, and even more importantly, I would say for us as traders, is sometimes the markets move in an unpredictable manner around the numbers. So it could be economic reports, etc. And so sometimes people are very surprised. You know, the market goes up on good news sometimes and down on bad news, and that's kind of what we would expect. But it's not always that way. Sometimes the market goes up on bad news and down on good news. And people wonder, well, that's not logical. Why does that happen? One of the reasons that actually happens quite often is because of, well, it goes back to Dow theory, which is called discounting the market, where professionals often take positions before the news is released. And this goes to the saying of buy the rumor and sell the news. And so the point is that trading fundamentals can be very tricky, and especially with regard to timing and anticipating how the market's going to respond. So when I say how the market is going to respond, what's implied in that is that it's people who are responding. In fact, if we really ask ourselves what is the market, and by that I mean whether it's the stock market, the forex market, the futures market, whatever market it is, the market is really a huge group of human beings. And so it's really important that you understand that, because when we're trading the markets, we need to trade what is, not just some theories or, you know, ancient Phoenician numerology or stuff like that. You know, mathematics are definitely an important part of trading, but it's really the people and the computers they've programmed based on their own philosophies, thoughts, feelings, and beliefs of the market that move the market. So the market moves based on mass psychology and auction theory. And so if you've ever studied market profile, I'd encourage you to study it. Whether you decide to use it for your trading or not, it's a great way to understand the dynamics of how markets move and why they move. It's just like when people go to an auction place and they bid on, oh, precious things, paintings, whatever. And of course, everybody wants to buy low and then later sell high if they're collectors. But sometimes people get very emotionally involved, and they just drive the price up and up and up beyond what's reasonable. And we see those same kind of dynamics in the financial market. So that's how markets move. When we want to talk about, and I call this market logic, this market logic is mass psychology of the movement of the markets. So markets move based on people's beliefs and feelings, but it's lots of people. So when we talk about the psychology of the market, the principles of mass psychology, which, by the way, are different than the principles of individual psychology. People behave differently as a crowd, as a herd, than they behave as individuals. So, bringing this full circle, when I talk about technical analysis, my definition of technical analysis is the mathematics of mass psychology. So when we're talking about being able to trade and trade right now and what the market is going to do now, what we need to do is analyze the mathematics of mass psychology. So the movement of the market is the movement of mass psychology. Therefore, the nature of the market is human nature. Charts are maps of collective human behavior. So that's really what charts are. They're maps. They're maps of what people are doing. And that word behavior is capitalized there because it is really the key. We've heard people say things like, oh, talk is cheap. Actions speak louder than words. Absolutely. We all know that to be true. And so when it comes to trading, I'm more interested in what the people are doing, people putting their money where their mouth is. There's another slogan for you that applies to the markets, than what the pundits say on TV or what some analyst thinks. You know, that and $10 will get me a cup of coffee at Starbucks. But what really matters, what helps me make money in the markets, is watching what people are doing, where they're putting their money. So the market isn't like people. The market literally is people. And nothing gets plotted on a chart until people take action. And this is why I like to trade based on technical analysis, because it's telling me, again, fundamental analysis looks at, okay, well, these numbers came in, so people should do this. Well, people don't do what they should do, right? If the people did what they should do, then all the junk food companies would be out of business. But they're not. In fact, they're thriving. So therefore, you can't trade that way. That's not a reliable way to trade. We have to look at what people actually do, and that is marked with charts. So charts don't map people's thoughts, beliefs, hopes, and fears. They map people's commitments. Only when people have put their money where their mouth is does it get put on a chart. And that's what makes them so reliable. So having said that now, okay, the nature of the market is the nature of people. Well, what's the nature of people? What's our nature like? Well, there are several things we can talk about. Number one, human beings tend to be very goal-oriented. And we grow up, and right away, as soon as we're born, we start having goals. We want to learn how to move, to be mobile, to walk, to feed ourselves, to learn, to grow, and you can take this all the way through life. Get married, get a job, provide, get strong, all these sort of things. So life is actually very linear. And so this goal-oriented nature of human beings reflects in trends in the market. Also, part of our life, part of our nature is as we're pursuing our goals, it would all be great if, you know, we'd start our New Year's resolutions and boom, every day we just kept to our diet perfectly and we exercised every day as we said we were going to do, but we don't do that. That's not normally what people do. If we do achieve our goals, it's in this fashion: 3 steps forward, 2 steps back. And so we oscillate. We might still reach the goal, but it's always a little bit, you know, moving forward, a little setback, move forward more, a little setback. And the markets do that too. The markets don't generally move straight up or straight down. They kind of wiggle up and wiggle down. They have oscillations in them. So you're seeing human nature in the movement of the market. Other times we stop oscillating and we just pure get stuck. We get stuck. And we even say that, gosh, I just feel like I'm stuck in my life. I'm not making any progress. And in the markets, we see this as consolidation. Number 4, we have cycles. We are beings of cycles. Our respiratory system is a cycle. Inhale, exhale. Our hearts work in cycles as we beat our hearts. We have cycles in our brain waves. We work, we rest. We have weekends off, and you know, we wake up during the day, and then we go to sleep at night. And it's a very, very, very intimate part, an integral part of our very nature. But cycles are also, just like trends, cycles are not neat and tidy. And so we get our cycles thrown off. In fact, if we keep to our cycles too often, we actually get bored. And so sometimes, I remember when I was in graduate school, I'd have to pull all-nighters and getting ready for a midterm or a final or putting together a big paper. And then after maybe doing 2 or 3 all-nighters together, then I would go and take a vacation. And in markets, we call these expanding and contracting cycles. Oh, I've seen on charts where they've had a little tool there where it marks out evenly, you know, whatever period of cycle. You can usually delineate whatever period you want there, whether it's a 9-day cycle, which actually is fairly common, or 30-day cycle or whatever. And it would be really, really nice if cycles were evenly spaced like that all the time. Gosh, trading would be so darn easy. But they're not. And so cycles expand and contract. Sometimes they last a short time, other times they last a really, really long time. And that makes it more challenging, but that's the reality, and that's the reality of people. We're messy. We're not that orderly. We're not that organized. And we're also very emotional. You know, a lot of people trade based on logic, and again, fundamental analysis and economics in general, the study of economics, kind of tends to, although there's certainly a lot of people who understand that this is not always true, but basic economic study tends to expect people to behave rationally, logically. And we all do to some degree, but all the psychological studies indicate that even the most logical among us ultimately make most of our primary decisions based on emotion and then justify them with logic. And then we also are excellent at denying that very fact. So I've worked with some companies as a consultant and CEOs, and every single one of them will tell me, oh yeah, I know most people behave emotionally, but I'm very, very logical. And I work with them for about a week, and right away I can see them making all sorts of emotional decisions. But again, they're excellent at denying that. So we are emotional beings, so we should embrace that. There's nothing wrong with that. And now psychologists are actually understanding that and accepting it and saying that there's some strengths to that. In fact, some studies have shown that people who make decisions based on emotion actually sometimes make decisions better than those who base their decisions on logic. And that's part of our intuition, because all of our experience is built into our brains, and a lot of the experiences and things we've learned that we don't even remember are built into those emotional decisions. So we love, we hate. We overreact, we become passive-aggressive. So we are logical sometimes, and other times we are not. And guess what? That's how the markets are too. Remember Greenspan's phrase, irrational enthusiasm? Remember the bubbles of the real estate market and the technology industry and heck, all the way back to the tulips? Well, that's because we're emotional beings. We do that stuff, and we make the markets move that way. That's us. Okay, so now that's the psychology of the markets. Now, what about me? That's the mass psychology. Let's talk about you as an individual trader coming to this market. All right, let's talk about your individual psychology. So Pareto's principle applies here. About roughly 20% of the people make 80% of the money. And some people think, oh my gosh, that's horrible, that's, something's wrong here, this is a ripoff. No, that's actually a principle of the universe. Again, that is not unusual. Same thing applies to any business, small businesses, big businesses, doesn't matter. That's just the way it is. And it's not just the markets. So, but what it does mean is that a minority of the people make the majority of the money. So you want to be part of the minority. Now, you're in this business because you think you can be in that minority. You think, hey, I can think different than the masses. And you have to, because the masses lose money. So you can't be part of the herd. You've got to stray from the herd. You've got to be an individual in order to be in that 20%. So the good news is you're here because you think that, yes, you are different. Here's the bad news. Every single person trading the markets thinks the same way. Everyone thinks they're different than the masses. So that, guess what? What that means is if you think you're different than the masses, you're actually thinking the same way as the masses because the masses think they're different than the masses. How's that for a brain twister? But it's true. And this in Chinese philosophy is what's called an iron circle. And it's not the same thing as circular thinking. A lot of times in the West, people think when I talk about this that I'm referring to circular thinking, and no, it's actually quite different. So in Chinese philosophy, the iron circle refers to probably the closest Western thing that we could connect this to would be a paradigm, where you're stuck in a paradigm. And you can't really think your way out of it. You have to transcend it. The only way out is to think differently, is to have a completely different paradigm. You have to transcend it. So how do we do that? Okay, now let's get to the first exercise. So how do we get out of this type of herd mentality? How do we get into a mindset that is the 20%er, where you can become profitable, where you're thinking differently? All right, so here's the first exercise. This is something that I did a while ago. I invite you to do it as well. It's going to take some time, it's going to take some effort, but guess what? Anything worthwhile does. Nobody told you, well, I don't know if they did, but I'm going to tell you, trading is not easy. It's not a get-rich-quick scam. It's not a scheme. It's a business. It's going to take some effort, just like anything else worthwhile in life. So this is something that you can do or you cannot do. You know, A.L. Williams, I believe it was A.L. Williams, said that, I'm not sure, but anyway, he or someone great once said that successful people do what unsuccessful people are unwilling to do. Not what they can't do, but what they're unwilling to do. You can do this. So here it is. I attended a bunch of free live trading chat rooms where traders are actively communicating with each other. Now the key here is, for this particular exercise, you want to join the trading chat rooms where there's not a professional trader leading. I mean, and I'm not saying those aren't valuable, but they can be extremely valuable. You know, they're great, and you should do that. But that's to learn from a professional. Our purpose here is different. So we want to get into the chat rooms where the professionals are not, where there's just a bunch of losing traders, and they're all yapping at each other. And listen to them. And then watch the charts that they're talking about. And watch the charts in conjunction with their comments. Now, remember, the masses are wrong most of the time. So what you're hearing is the inner dialogue and the behavior of the losers. And I don't mean the word, I'm not using the term losers in a derogatory way here. I just mean it in a very literal way. They're losing money. So I did this for about 6 months, and I would say do it for a minimum of 3. All you do is sit there, listen to their comments day after day after day, and watch the chart in conjunction with their comments. And what you're going to notice are patterns. You're going to notice patterns of things that they say over and over and over and over and over and over and over, because these are their thought patterns, and they're normally wrong. So, for example, I'll give you one example that came up all the time. So the market would be moving up, and be moving up and up and up and up, and then, you know, people would start saying, oh my gosh, this market is way overbought and it can't go up any higher, and they justify it with whatever, an indicator, a Fibonacci number, average true range, whatever, didn't matter, right? They had some justification. Stochastic, CCI, RSI, LMNOP, whatever. Okay. And they say, I can't go up any further, so I'm taking this short here. And so they take it short, market would retrace, you know, a little bit, just enough to fill them, and then it would turn right around immediately after they got in and make higher highs and stop them out. And the person says, oh my gosh, I can't believe that happened. This is crazy. That's ridiculous. Okay, well now this thing is really, really toppy. Oh, that's another term I heard all the time, the term toppy. Toppy, that's an interesting word. I never hear any professional technical analysts use the word toppy. But I heard this all the time. Oh, the market's really toppy here. It's way beyond, you know, statistical probabilities of going any higher. So, and then again, they justify with some sort of indicator, candlestick pattern, price pattern, whatever, and they'd go short. And sure enough, the market would go down a little bit. They'd get filled, and then it'd turn right around, go back up even higher, making higher highs, and take them out again. And then they'd get really upset. And then, you know, then they'd be like, oh my gosh, this is ridiculous. This market doesn't make any sense. And they should know that. Of course, the market doesn't make any sense. They're expecting the market to make sense. Market doesn't make sense. So that right away is a problem, that they think the market makes sense. And then they try it one more time. And they go short, the market takes them out, makes higher highs. Then the real colorful language would start. And then they would usually say something to the effect of, I'm done, I'm out of here, I'm going to play golf, tennis, whatever. And if I heard that once, I heard it 1,000 times in 6 months, that same pattern. There's just something in us that is contrarian, that always wants to trade against the trend. And so, again, what I did was I would watch, or I'd listen to their comments and I'd watch the chart. Now, what happens is with this repetition, and the reason that you need to do this for a long period of time is to get this stuff ingrained in your head so that pretty soon you can do the opposite. Instead of listening to the comments and looking at the chart, you can look at the chart and start to hear their comments in your imagination, in your brain. Why? Because you've heard it so many times that you now know, oh, when the chart looks like this, here's what the retailers or the literal losers are saying and doing, because it's so freaking common. It is so consistent. I'll tell you, losing traders are very consistent at losing. And they're consistently doing the same wrong things over and over and over and over. In fact, there's even one leading trader out there who I can't mention his name, but he would call this find the loser. Find the loser. And that's he traded this way, finding the losers. And so basically this is what I was doing too, but I was doing it by actually getting into their minds and being able to then do the reverse. Look at the chart and say, oh, I know exactly what the losers are saying here because I've heard them say it 1,000 times. When the chart does this, here's what they're thinking, here's what they're doing, and I'm going to do the opposite. So great exercise. It works. Again, does take some commitment, but boy, I'll tell you what, it'll help you. Here's the thing. We're not trying to hurt them. We can't save them, right? The only way we can save them is through education, and, well, that's what I'm doing. I'm trying to save all the losers and turn them into winners. So that's what I'm trying to do. But the point is, you can't be part of the herd. You've got to be different than the masses, and here's how you do it. Now, it's very hard to do that on your own. In fact, when I started doing this, I was like, yeah, you know what? He's making sense here. And I would take it and trade with him. Pretty soon, what I realized was I'm thinking the same way this dude is. And it helped me to get out of that mentality, out of that iron circle. So, great book. I'm sure many of you are aware of this book, a very, very famous book, Market Wizards. You should read it. It's excellent. There's a whole series of them. Jack Schwager, what he did was he interviewed some of the world's most successful traders. And the purpose of interviewing all these successful traders around the world was he was looking for a commonality that could lead to success for others. So he was looking for, what do all these successful traders have in common, and how can that inform us to become successful? And here was his conclusion. He said, what set these traders apart? Most people think that that winning in the markets has something to do with finding the secret formula. The truth is that any common denominator among the traders I interviewed had more to do with attitude than approach. Very, very powerful insight. You need to take that to heart. In his follow-up book, The New Market Wizards, he wrote, when asked what was important to success, the market wizards never talked, listen to this, because this is, again, not how losing traders think at all. The market wizards never talked about indicators. Everyone's looking for a magic indicator. No, not winners. Not about indicators or techniques, but rather about such things as discipline, emotional control, patience, and mental attitude toward losing. The message is clear. The key to winning in the markets is internal, not external. Absolutely 100% true. So it's obvious that to be a successful trader, you need a viable trading method with setups, rules, and a plan that works. Without that, of course, no amount of psychology is going to help you. Unfortunately, there's many traders who actually have a viable trading method, but they don't even know it. Why? Because they've never tested that method divorced from their emotions. So this is why I highly recommend that you paper trade any new method or better than literal paper trading. Today we've got the technology of using demo accounts or simulator accounts. We can actually, put your order in, get used to processing that order just like you would, but just not with real money. And any new method, even if you're already a successful trader, if you're trying a new method, always go ahead and paper trade it for a minimum of 3 to 6 months. That's assuming you're day trading, by the way, and you're getting a lot of repetition in the 3 to 6 months before you put in a single real money trade on the line. And this must be done in real time, not after the fact. And the reason for that is you can't successfully trade a methodology just in hindsight or in history. As we've seen in disclaimers, past performance is not indicative of future results. That's absolutely 100% true. But you also need to trade it with your own behavior, your own emotions, your own actions. In other words, you need to be there doing the thing to see if you can trade it. Because you might have hey, I've got friends who have great trading methods that work and they make money. And I know their methods. And I can't make money with their methods. Why? It doesn't fit my personality. It just doesn't feel comfortable for me. It doesn't fit my psyche. So you've got to get in there and you've got to actually execute those trades before you know if it's going to work for you. So this also, of course, gives you the benefit of learning the timing of the entries, getting used to the timing of pressing that order button and the feeling of being in and getting out. Learning to enter your orders without hesitation is critical, and to see if it fits your personality, like I said. So by paper trading for 3 to 6 months and keeping track of every trade, you'll find that, if the method works for you, as long as you trade it without emotion. So you got to have confidence in the method first. And without confidence in your method, you're going to second guess the rules, get discouraged during drawdowns, be fearful. So you've got to do this. It's absolutely, absolutely critical. Overtrading is one of the biggest challenges to new traders. But one of the hallmarks of successful traders is we actually trade very little. Most things in life are different than you imagine them before you get in. So, and for me personally, and as I've followed other traders as well, some of my mentors, what I've found is the longer we trade, the less we trade, the less frequent we trade. We get real picky, get very protective about our money. And so we trade a lot less than you probably think we do. Even in the gambling world, professionals know this. When I talk about gambling world, I'm talking about poker. Poker, not, one-armed bandit here, where it's just pure chance. So I'm talking about, a game like a game of Risk that has a psychology to it, like poker, which definitely does. Profitable poker players fold on more hands than they play. If they don't have a strong opening hand with a high probability of winning, they simply fold and wait for a better one. Now, we have an advantage over them in that they have to ante up every time. We do not. We do not. So we can sit and wait for free. Here's one of my favorite trading quotes and one of my favorite trading books. And it's not even a quote from a trader, and it's not a book about trading. And I'm not a gambler, I'm not a poker player, but someone told me to read this book, and boy, am I glad they did. John Patrick, the book is Money Management for Gamblers, and he is a professional poker player. And this applies to trading so beautifully, it's stated better than I've read in any trading book. So he says, people are way better educated than me, rip my theories from here to Hades and back. See, that applies to trading. You think, oh, all these geniuses, you've got to be some kind of mathematical genius to be successful at trader. No way, not even close. They claim gambling is all math and statistical analysis. Again, no. They will never grasp the true meaning of gambling because they have never been there. People who think that a math equation is going to give them a leg up on winning ought to have that leg whack them in the area where they sit on their brains. Okay, he's a colorful character. I wouldn't state it that way, but the pros don't make mistakes, and they don't have tells. Now, we're going to talk about this in a second. The capitalization there is mine. They don't make mistakes. Okay, we're going to get to that here with our second exercise in just a minute. Patience is a virtue. Remember, overtrading. No overtrading. Patience is a virtue. Stupidity is a one-way street to disaster. Talk is minimal. Mercy is absent. Make a mistake, and 7 vultures circle the wagons waiting to divide the spoils. When the night is done and you're fortunate enough to escape with a small profit, the ride home gives you only a short time to count your blessings and your money. Very well said. So, okay, I'm running a little short on time here, so I'm going to skip through this. If you guys want, I have a list of the 10 most common mistakes made by traders, and I'll be happy to send this to you for free. Just send me an email at .com, and I will skip through these couple slides and get straight to the exercise. Okay, so, but here we go. Here's the exercise. So the exercise is this. By the way, yeah, the email is Barry, B-A-R-R-Y, at topdogtrading.com. And I will send you the list of the top 10 mistakes, and I'll also send you copies of these trading logs. Now, my trading logs are very different than regular trading logs. Regular trading logs, you just enter when you got into the market, when you got out, all that kind of stuff. Okay, well, that's fine, but, you know, your broker supplies all of that. So here's the key. I'm going to focus on a couple of things. So this has room for 3 trades on a page. And that's not a bad thing to do. If you're a day trader, is to say, hey, I'm only going to take 3 trades today, and therefore, so I got 1 sheet for the day. And that helps you from over trading. You're only going to take the 3 best trades of the day. So you put in your time, you know, which market you're trading, blah, blah, blah. Okay, that's all when you got out, how much you made. All right, now here's the more important part. In the notes section, you put when you took the trade, you write down what you were thinking and what you were feeling. It's a bit of a biofeedback. What were you thinking and what were you feeling? And then in the mistakes area, you write down any mistakes you made on the trade, such as, oh, I moved my stop. The market went to take out my stop and I moved it, and the market went even further against me, and so I took a really big loss. Or I got out too soon. Just the opposite. The market went in my direction, and I got too excited because I made $10, and I saw, wow, 10 green dollars there, and so I took it. You know, that's a little extreme, but maybe you made $100 and you got all excited, and you could have made $1,000. And so anyway, you got out too soon. That's another common mistake. So whatever the mistakes were, if there were any, you put them there. All right, so these are the 2 critical areas. What you're thinking, what you're feeling. What are you doing? You're monitoring yourself. It's kind of like the chat room, except now you're watching your own thoughts and feelings and write them down. And then any mistakes that you made. Okay? Now, that's the daily trading log. Then we take it, here's the weekly trading log. So at the end of every day, this assumes you're a day trader. You can do this, though, for swing trading as well. Just use different time frames. So here's day 1, 2, 3, 4, and 5. Each row is a day of the week. So when you fill out the whole thing, you'll have a week's worth of trading here. So on each of these rows, you'll take this day. Let's say today's Tuesday, so let's say you're down on this row. And you'll summarize everything for that day. So here's your date, how many wins you had, how many losses you had. What was your total profit? What was your total loss? What was your average dollar win? What was your average dollar losing? Adding any commissions. Now, this is the net P&L. Okay, so your net profit or loss after commissions are subtracted. Then this column is the percentage of your account that you went up or down. Now, it's very important for money management, so that you need to have a money management rule that says I will only lose this amount per day, per week, per month, per quarter, so you don't blow out your account. Number of mistakes you made. How many total mistakes did you make? Now, how much would I have made if I did not make any mistakes this day? That's the critical one. And then over here, list the actual mistakes and how many times you did it. So maybe you'd say, okay, I moved my stop and let the market move against me further than I should 3 times. I got out of the market too soon 4 times. And you rate that there. Now, here's the key. Here's what makes this work. By doing this for, say, a month, you'll have 4 of these weekly trading logs, and you will see patterns. And you will look at your daily trading logs, and you'll see a pattern of your thinking, your thoughts, and your feelings, and what happened when you thought certain thoughts, and what happened financially when you were feeling certain feelings. You'll see patterns there. Then you can reverse that, just like we did with the chat rooms. So then you say, oh, you know what, every time I think, like, oh, this looks toppy, you might even write that down, this looks toppy. And then you'll notice, dang it, every time I think this looks toppy, I lose money. And so the next time you trade and you say, okay, this looks toppy, oh, wait, I just said this looks toppy. Oh, no, I never win when I say that. See how that changes your behavior? Then also you can do that with feelings and certainly your mistakes. Now, we all have our own favorite mistakes. You know, so I've got the 10 on the list that I'll send you. But those mistakes, like I said, we each have kind of our own favorites. So what you're going to find out by listing them here are what are your most common mistakes. Nobody ever becomes a perfect trader, but you'll see the ones you make the most common. And we don't ever have this in our mind. You can't keep track of this in your mind. We have a general awareness of it in our mind, but it's not till you put it down on paper that you start to realize, oh my gosh, I really do that often? I had no clue I did it that much. And then the motivator is this column, is showing yourself how much money you would have made if you simply didn't do those mistakes. And I've got to tell you, I've done this with individual traders. And what's astonishing is they are already profitable traders if they just stop doing the mistakes. They're out there searching for more indicators, more courses, more this, more that, more mentors, more gurus. And they realize, actually, all I need to do is stop doing these 3 mistakes that I do all the time and didn't realize it, and I'm already profitable. Now, that's not true for everybody, but guess what? It's true for a lot of people. It really is. It's amazing. So I encourage you to do that. There's my email address, barry@topdogtrading.com. Feel free to send me an email, and I will be happy to ask for the 10 most common mistakes and also the trading logs, and I'll email those over to you. Also, I promised I'd give you my one of my trading courses for free. So it's a 5-day video correspondence course. It's basically, the concept of it is how professionals trade differently than retailers, some of the things we talked about here today. So there's 5 videos in this course. At the end of each video is an interactive quiz, so you can test yourself on it. As I said, I give you one of my favorite trade setups, the rubber band trade in there. And then also I'm going to have another webinar, a freebie. It's another freebie. And in that I'll be talking about timing, how to time your entries, how to time your exits with my cycle indicator. And I'll actually give you my cycle indicator in that webinar. Again, all for free, no charge for any of this stuff. So if you simply go to topdogtrading.com/free.html, sign up there, and we'll send everything over to you. Okay. So that's it. Thank you, everybody. Fantastic. Thank you for hosting this Investor Inspiration. You guys are fantastic. Thanks, everybody, for taking time out of your day to be here. Hope you found this helpful, and happy trades.